have cost of site preparation. For example, you buy a like for example oil well. The oil industry, they can buy oil. For example, there is preparation, land preparation. You can prepare the land for its intended use. Is part of the cost. Initial dribbling and handling cost. If there is any handling cost or any delivery, installation or assembling cost. So assembling cost is also part of the cost. Cost of testing proper functioning. So the cost of testing whether that asset is functioning or not. For example, there is a lot of machine once you purchase, you need to test run. And you need to test run after you test run. So the cost of that test running is what? Is part of that cost of the asset. But there are some argument again. The proceeds of, like for example, you buy a machine of production of pure water, and then you produce the pure water for the first time. So that pure water, the first pure water, the test run that you test run, once you sell it, it will not reduce the cost of that cost of functioning. No, you have to take it to profit and loss. That is another this thing. Then professional fees. For example, sometimes there is architecture, there is engineering fee. You have to what? Include them as part of the asset. Then there is the commissioning cost. That's dismantling or dismantling cost. The commissioning cost. Like for example, in oil industry, for example, you can extract oil. After you extract oil, there is, you must what? You must make that land habitable. So the cost of dismantling, you need to include it. But this one, you need to discount it to the present value. So you need to discount it to the present value and include it as part of that asset. So we have the borrowing cost. So the borrowing cost also is part of that cost of asset. Like the borrowing cost. When we go to the borrowing cost, we will, that's IS 23, we will dig deep here, because there are at times there is ideal time. So ideal time will not be part. So the borrowing cost, when the cost, then you need to, there are specific and general the borrowing cost. So when we reach to these standards, we will, okay. Activity one, initial measurement. So this is just an exercise. So this is an exercise. So we just want to familiar with what will be included as a cost of an asset and what will not be included as cost of an asset. So if you can remember from this one that says directly attributable cost of bringing the asset to the location and condition necessary for it to be able to operate as intended use. So this cost, so for example, you can stop a cost a cost will not be included when the asset is ready for its intended use. So we have this initial this thing on 1st October. So let me bring down this thing. On 1st October, Daring acquire a machine under the following items. Manufacturer base price is 1,050 naira. Then 20% trade discount on base price. So there is 20% discount on price on this base price. So we have then the second one, 5% early settlement discount taken. Offer only the base price. So this settlement early settlement discount is when, for example, you supposed to pay 1,050 naira. So maybe the settlement date is you will settle this payment in 2 months. So for example, maybe you now decide to settle that payment in less than 1 month. So you will be entitled to this 5% of the cost price. So the you will not pay the 1,050 naira. You have to deduct the 5% so that it will give you the what? The early settlement discount. So, but this early settlement discount lies with the company. If you like, you can exercise. If you don't, you can. Some company, if they have the money, they can settle it within that this thing. But sometimes if that money, if for example that money you can invest it to another investment and retrieve your maybe more than 5%, then it is better to delay and pay exactly when it is 2 months. Then freight charges. We have electrical installation cost. We have staff training in use of the machine. That's 40. We have pre-production test, 22. Then we have purchase of a 3-year maintenance contract. That's 60. So this is initial measurement. So we will look at a comprehensive practical question. But hello, I hope you can hear me.
Yes, sir.
Okay.
Yes, we are with you. We are with
Okay.
you.
So let me. Can you see my screen, or I have to? Let me. I'm coming. Let me share entire screen. Okay. Now, so let's do this. Okay. So the requirement. You can see my screen now, right?
Yes, we can.
Yes.
Yes. Okay. Now the requirement of this illustration, we have determine the initial amount to be capitalized for the machine on acquisition. So now, let's do it this way. So now, to calculate this, we have that's manufacturing. So the manufacturing, we have 1,000. So we have, so here there is 20% trade discount on base price. So this trade discount, we have to deduct it from the cost because it has nothing to do with the assets. So when we say trade discount, so is what? Then we need to count. Equals, sorry, my system is listen, sorry. 0 point what? 0 point okay, 0.2%. That's the element of the trade discount. So 0.2% times sorry. Sorry, I'm using another system, and then all this system that you see this thing, but it's not what is there. So on the keyboard, so I find my this thing times this amount. So 210 is the cost, is the trade discount. So we have to deduct this. So equal to this minus this amount. So this is what we have after we deduct our trade discount. Then we have freight charges. So this is what is the carriage. So we have what 30. Then we have electrical installation cost. Is this included or is not? Hello. This electrical installation cost, can it be, is it a cost component or not? Hello.
Hello.
Are we together?
Yes.
Okay. I'm asking this electrical installation cost, is it part of our cost or not?
In determining what, sir?
Eh?
In determining what?
Hello?
Can you hear me?
Yes, I
Hello,
can
can you
hear
hear me,
you
sir?
now.
Yeah,
Yes, I
electrical
can hear you.
installation. In determining what? It depends on what you want to determine.
Okay. Yes, this is a part of the cost. They said we purchase the asset based on the price. That's 1,000. And then there is discount. There is freight charges based on that asset. And there is electrical installation cost for that asset.
Okay.
So,
Installation. I see installation as an expense. It depends. Issue of assets. I think materiality also counts here.
mhm.
Materiality of the installation cost is what we
So,
are looking at.
so what happened is that this electrical installation cost is part of the cost of that asset, because this asset, we said any cost that is attributable or associated,
Okay.
that cost that will make it to be what? To be ready for
Functional,
use
right?
should be included.
Okay.
Hmm?
Okay. Okay.
Yeah?
I understand you.
Yes, that cost that without it, that asset will not function. So without this electrical installation cost, so this asset will not what? Will not function. So we have electrical cost. Then what about staff training in use of the machine?
It will not be
Staff
added, sir,
training in use of the machine. Okay, why?
because without the staff training, you can still use the machine.
Mm-hmm.
The machine can still be used for the time being.
Would be added. Hmm?
Hello, are you with me, sir?
Will not be added. Yes, I'm with you.
Yes. Because it will not stop the machine from working.
Mm-hmm. Yes, yes. So it's the same thing that this asset will not disrupt this machine from what? From working. Whether we train the staff, we did not train them, has nothing to do with what? With the this thing, asset. Then we have the next one. So if the asset, if this cost, if if this cost is not part of our cost, then where will you where will we put this cost?
We expense it.
Then the cost will be expense. It will go to this in profit
P&L.
and loss. Yeah, yes, P&L. Then we have pre-production testing. Pre-production testing is what is part of the asset.
Yes.
So production testing is also part of the asset. So we have
I have a question, sir.
Okay, you have your question. Okay.
Yes, sorry, I've been trying to join, but I was having challenges with the link.
Okay, with the link. Okay.
Yes. So
Okay.
I don't know what topic are we treating?
Okay. So to recap, we are treating IS 16, that's non-current asset.
Okay. Okay.
So
All right.
we are treating IS 16. So we want to know the cost, initial cost of that asset. That's what we are doing now.
All right, sir. Thank you, sir.
So, you're welcome. So the purchase of a 3-year maintenance. So this is it. So the purchase of a 3 years maintenance cannot be part of our assets.
Mr. Abdullah, please mute your.
Okay. So cannot be part of our asset. Purchase of a 3-year maintenance contract will not be part of our asset cost. So this is an expense because it's a maintenance cost. So what we will add once we add, so we will add this equal to, so equal to summation. Okay, that's a summation from here to here. So this is our, sorry, I did not close the bracket. So this is the cost of this asset. So this is what we will capitalize. So this is the cost of this asset, 920. So is this asset that we will depreciate? This will be the cost for this asset. So do we understand? Can we move forward?
Yes, we are getting you, sir.
Okay. Then we have subsequent measurement. So this subsequent measurement, so as we check, as we have it before now, we set initial asset at initial. When you are recognizing it, you have to do it, you have to recognize it, you have to measure it at cost. So subsequent measurement lies on you. There is two options for subsequent measurement. So it is either you go for cost model or you go for revaluation model. So these two is the cost depend on the policy of the organization. But the policy says that for asset class, you must use what? Cost, you must use a similar model for all assets in the same class. Like for example, building land. So like for example, machineries. So machineries, all the machines, whether is this thing, whether is a machine for this, once you measure, once the subsequent measure you choose cost model, then you need to apply, it will apply to all. It is either you use cost model or evaluation model. That's the two. Then under the cost model, an asset is subsequently carried at cost less any accumulated depreciation and any accumulated impairment loss. So we have at cost. So when you remember the cost of that asset that we realize is 920, and that 920, when we choose cost model, the following year we will take that 920 minus depreciation minus any accumulated impairment, if there is any impairment loss. So this impairment, so this impairment, we have IS 36, that's what major impairment. So we will look at that IS 36. So this is the cost accumulated, the cost model. So if you have cost model, you have less issue. But revaluation model, under revaluation model, an asset is subsequently carried at a revalued amount, being fair value at the date of the revaluation less any subsequent accumulated depreciation and any accumulated impairment lost. So, you know, the initial cost is what is at cost. So you need to check the fair value of that asset and you measure it with the cost, the carrying amount. So after you measure it, then you now write it down to the revalued amount. So that's the revaluation. You need to revalue the assets on and on. So by the time you revalue it, sometimes you can revalue it every year, depend on the assets. So by the time you revalue it, is that revalued amount that will be the cost, that will be the carrying amount of that asset for that year. So that's a revaluation model. And revaluation model, you will still deduct what? Accumulated depreciation and any accumulated impairment loss. So then another point, the revaluation model is an accounting policy choice and must be applied to all assets within a given class. That's the point I made that time. then all revalue assets except land are still depreciated. So whether we know land is not depreciated, so um, whether uh, uh, whether you use cost model or you use revaluation model, you must what you must depreciate that asset. Then only those assets whose fair value. Then there is another standard here, International Financial Reporting 13. So only those assets whose fair value can be measured reliably may be revalued. So the revaluation model have has its limitation. So there are some assets that to get their fair value, you cannot get their fair value. So you need to what? To measure it at cost. But if that fair value, if the asset, the fair value can be measured reliably, you can use that. Then revaluation must be carried out with sufficient frequency such that carrying amount does not differ materially from fair value at any reporting date. So you need to do it frequent. frequent. So we have accumulated depreciation. At the date of the revaluation, accumulated depreciation is either restated proportionately with the change in gross carrying amount so that the carrying amount after revaluation equals its value amount. Eliminate against gross carrying amount and the net amount restated to the revalued amount. So we'll go that. So now, revaluation. We will go into the revaluation. So revaluation, if you choose revaluation method, definitely there must be increase in valuation and decrease in revaluation. There must be an increase or decrease. As sometimes you can value this building today, but like this year, next year, it may it may appreciate, or it may appreciate this year, next year it may depreciate. So depends. So there might be an increase or decrease in revaluation, an increase or decrease in carrying amount as a result of a revaluation is accounted for an asset by asset basis. So one, revaluation increase is credited to OCI, other comprehensive income, and transferred what to a revaluation surplus in equity. This is the contradiction place. This is it is contradicting. So what you will use here, what you will use is that any increase in revaluation should go straight to OCI, other comprehensive income. Every increase in revaluation should go straight
Hello.
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 Yeah, sorry, I use my phone to hotspot. So, and my phone went off. So, let me share my screen. So, we are here, this revaluation. So, this is where a place that is very difficult. So, revaluation, what revaluation, any revaluation increase is going to OCI straight. Then any revaluation decrease is going to P&L. So, but then there is reversal, revaluation reversal. For example, so now, for example, I revalue this building today. So there is revaluation increase. I took it straight to OCI. So, but subsequent year, the next year, there is a revaluation decrease. So I have to what? I have to take it their rates to what? To OCI to reduce that what? That to hit that revaluation surplus I have in that OCI. So what is happening here is that revaluation decrease hits a revaluation decrease or surplus hits the account where it was initially there is initial increase already or there is decrease already. So for example, if it is decrease, so if it is decrease, so now there is a revaluation decrease, but I have to check, did I have revaluation surplus based on that particular asset? So if I have the surplus, I have to go and hit the surplus. So wherever the surplus is, I have to go where? To there and hit that surplus. So, and then if it is revaluation Okay, let me just do it like this. For example, initial year, on the first year, you have revaluation. It has to go to NCI. In the second year, maybe, and in the first year also, maybe, I have revaluation decrease. I have to what? I have to take it to what? To P&L. But in case of, for example, I first recognize revaluation decrease in my P and L. So, and the next year, I have revaluation surplus. So, the revaluation surplus will not go to OCI. It will go to where I have decrease and hit it in what? In P&L. So I don't know if you understand this part. This is what is there. Hello.
Hello, sir.
Yeah, I don't know if you guys understand this explanation.
Yeah, we are flowing.
Okay. So now here, revaluation increase, however, must be recognized in profit or loss to the extent that it reverses a revaluation decrease previously recognized as an expense. You see, this is what the explanation I did. Then revaluation decrease is recognized as an expense in profit or loss for the period. Then a revaluation decrease, however, must be recognized in OCI to the extent that there is a revaluation surplus relating to the specific asset, you see. Then amounts recognized in profit or loss are presented in the operating category. Amounts recognized in OCI are presented as OCI that will not be reclassified to profit or loss. Then we have depreciation. Depreciation is simply means allocating depreciated amounts to an asset. For example, depreciation, we know that depreciation, we cannot expense the cost of an asset because of the number of years, and because of the huge amount of the money, we cannot expense that asset immediately. So that's why we create depreciation, where we charge it what? Yearly. We charge it yearly, where we will depreciate and charge, so that at the end of the useful year, we can charge all our expense. Thus, we can realize all the costs we incurred. So that's what depreciation does. So after revaluation, an asset continues to be depreciated over its useful life, resulting a higher annual depreciation expense if the revalue amount is greater than historical cost carrying amount. That's which is true. A lower annual depreciation expense if the revalue amount is less than the historical cost. So we have transfer to retain earnings, where a revalue asset carrying amount exceeds the historical cost carrying amount. RS 16 allows but does not require the transfer of the excess depreciation expense from the revaluation surplus to retained earnings. This means that retained earnings are not reduced as the result of a decision to adopt the revaluation model. So here, for example, where there is a revaluation, where there is a revaluation increase, that's surplus, we what? There is an account in equity, revaluation surplus. So by the time that asset is realized, or you can transfer some of the revaluation surplus to what? To the returns earning. So disposal, when a revalue asset is disposed of, any remaining balance on the revaluation surplus may be transferred directly to retained earnings. You see, so the disposal represents the realization of this surplus. So in case when there is a revalue asset was disposed, so in case of any, if there is any revaluation surplus, it will what? Transfer to retains earning. Then we have subsequent costs. So subsequent costs, the issue asset expenditure. So now, if now subsequent costs, there are costs. These subsequent costs are costs of maintenance, right? But there are costs that is huge, like a overhauling. When you are doing overhauling of engine, it has a huge cost. So can that cost be expense or should be added, should be capitalized? Hello?
It should be capitalized, sir.
Should be capitalized because what? The cost of the asset. So some they can say it is an expense, but actually it's not an expense because it is an expense when it maintains the what? The economic value of that asset. But if it
Yes.
improves the economic value of an asset, is what? You need to what? To capitalize it. Then to the statement of financial position or expense to the statement of profit or loss. The distinction depends on whether a particular cost meets the IAS 16 reconciliation criteria, whether it will result in probable economic benefit. In some cases, it is unclear whether a cost will generate new economic benefit or simply maintain or restore existing economic benefit, and therefore judgment is what is required. So you need to ascertain the criteria. So is this cost? So when I spend this cost on this building or this cost on this machine, will it result in probable economic benefit? In some cases, so then IAS 16 says provide guidance in respect of subsequent expenditure on repairs and maintenance, the replacement of parts and overhauls and inspections. So there are placement of parts, like for example, in machine, like in let's say motor vehicle, you change brake parts. Is brake parts an expense or you have to capitalize it? Hello?
Hello.
Hmm. It's
You
an
you change a
expense.
brake,
You change a
but
brake part of a vehicle.
yes, sir.
Is it the cost of that brake pad, should we capitalize or should we expense?
I see it as capitalized because of it to add the economic benefit to the asset.
Yes, before you capitalize a subsequent expenditure, right?
Yes.
You know the cost also is minimal.
Okay. Sorry, sir. That's this cost of maintenance. But I
Is
see
the
it as
cost of
replacement.
maintenance. So depends. Like when you go to aeroplane, like the engine is separate from the what? From the frame. So sometimes in aeroplane in airport, you can see an engine will have a useful life of, let's say, 10 years. But the body of the this thing of the plane will have useful life of 50 years. So before you can say that this replacement cost is an expense or I need to capitalize it, you need to check the depreciation. Does I depreciate this amount, this part separately? That's what we call complex what? Complex PPE. So this is complex because what? You will see there are some, like for example, there are some building that you see the roofing is the useful life is different, and then the useful life of the building is separate. That's the roof and the building is separate. So you need to what? So you need to capitalize them if that cost overhauls, like in aeroplane. I think it's either every year they used to what? Overhaul the aeroplane. So that cost cannot be expense. It has to be what? Capitalized. So that's it. Then that's about this thing, subsequent cost expenditure. Servicing costs, e.g., labor and consumable, are what? Are recognized in profit or loss as incurred, often labeled repairs and maintenance. This expenditure is made to restore or maintain future economic benefit since it does not enhance future economic benefit. So you see, if repairs and maintenance, if it will either restore or maintain, it will just maintain the what? The economic benefit of that asset. But if it is going to enhance the future economic benefit, this expense is what is recognized in the profit or loss. So this depreciation as a whole. So here it has been argued that why are we depreciating an asset? Why? If I may ask this question.
Wear and tear.
Well,
Wear and tear.
what? Wear and tear. So we depreciate assets wear and tear. So some they said that because sometimes the cost of that asset is much. the maintenance is much. There are sometimes the maintenance, they will expense the maintenance and you will expense, you do a depreciation again. It's just as if a double charging. So there are some arguments that some assets should not be depreciated because of the what? Of the expense. So here it has long been argued that certain assets should not be subject to the general rule that all assets should be depreciated. That's some certain assets. Many companies in some jurisdictions have taken to the practice of not depreciating some types of assets, like e.g. hotels. You know, the cost of maintaining the hotels is high. So they said, why are we depreciating? Like, it's just like, just to this thing, like the argument for non-depreciation, assets are maintained to a very high standard. This maintenance cost is expense in the statement of profit or loss in lieu of depreciation. To depreciate also will be double counting expense. So here they says some of the expense of hotels, we cannot capitalize them because of the criteria, because of the standard. But we still depreciate the asset also. So what is the essence of us depreciating that asset, since the cost of that asset is being expensed in the profit and loss? Then residual value is at least equal to the carrying amount made due to maintenance. So there are sometimes, how can we say you can depreciate your asset? Like, for example, now your carrying amount. Like, for example, I have this building, I have a building as a maybe 5 million in my as my carrying amount, and then you want to sell the land, and the land is also what appreciated, especially let's say a car. Sometimes you can buy a car years back as what, as maybe 3 million, but now the car, if you want to sell it, you sell it at the rate of maybe 4 million. So you see, so that's the point, that's the argument that they brought about this argument on what should we depreciate other assets. Then we have assets have a very long useful life such that depreciation is not material. For example, you can say this building will last for 50 years, but in the real sense, maybe it will be more than that or lesser than that. So since what the assets have a very long time, at times you can say this asset will be 4 years. Before you know, the asset is more than the 4 years. So that's their argument. Then asset is not currently in use. So some asset is not currently in use, but you have to depreciate. That's their own argument. So this is the argument. So we have residual value. What is this residual value? The residual value, the estimated amount currently obtained on disposal of an asset after deduction of any disposal cost, on the basis that the assets were already of the age and in the condition expected at the end of its useful life. So it's just an estimate. If I want to sell this asset, how much will I realized. So that's a residual value. Then most assets have a negligible residual value, but some assets, such as building, may have a residual value that exceeds carrying amount. This is what I'm talking about. Depreciation will then be zero until the residual value falls below the what? The carrying amount. So sometimes some assets, they don't have a residual, the residual value is even higher than the carrying amount. So that's then we have a residual value, and the useful life of an asset must be reviewed at least at each financial year. So the residual value should be what? And the useful life of an asset must be reviewed. We have to review it. For example, each year we have to review, okay, this residual value has changed. This useful life, this 50 years that we said this building will last, will it last up to 50 years or not? So that's the residual value. Then IS 16 and the conceptual framework. So IS 16 and the conceptual framework. Under IS 16, an asset is measured at cost. We know that one. There is therefore no definitive treatment for assets that have no cost. So you see, under IS 16, IS 16 said that an asset is measured at cost. There is therefore no definitive treatment for assets that have no cost. So there is no, what if this asset has no cost? How are we going to treat it? So this gives rise to different treatment of donated assets, for example, which is particularly relevant to charities and other not-for-profit organizations. Although under IS 16, there is no cost for the recognized to be recognized. The financial statement will be more relevant and faithfully represent the financial position of the organization if the assets are included at a fair value. So this, despite the fact that IS 16, they said there is no cost, but it will be fairly represented or more relevant to represent the financial position by using that asset that has no cost to have the fair value. So yes, this has no cost, but how much will I realize if maybe at all I want to sell this? Yes, I know there is no cost, but how much? So it is better you measure it at fair value. Then the framework states that the absence of related expenditure, that's cost, does not preclude an items from meeting the definition of an asset, e.g., free of charge, government grants, and donated asset. So what the framework says that whether there is cost, whether there is no cost, there is no will not the definition is still the definition of an asset. So you see, it is IS 16 that go further and check the criteria, reconciliation. What is this and that? But a conceptual framework just said that an asset is a resource controlled by an organization. So it doesn't say an asset is something that has cost, but it is what? It is what? A resource is control. As far as you can control, is control the asset. That's the conceptual framework. So that's the setback of that conceptual framework. That's why the International Accounting Standard Board, before they issue an standard, they have to consult the what? The conceptual framework. That's the reason why we said if there is no, if the standard did not capture some of the transaction, the conceptual framework should be used. But if there is a standard, so conceptual framework should be what? Should be cited. So I took my time about this theory because in every Ican exam, you cannot do away with IS 16. It is either you solve it directly or you solve it indirectly. So non-current assets, as far as you do financial position, you must encounter non-current assets. This non-current asset can either be profits, property, plant and equipment, investments, property, that's IS 40, or intangible asset, IS 38, or borrowing cost. So all those you must encounter this. So is there any question before we can do practical question?
Excuse me, sir.
Yes.
In a simple term, how can one explain borrowing costs to me?
Okay, borrowing costs to you. Borrowing costs is just what is the cost. A borrowing cost is what is the cost of borrowing. That's the cost you borrowed in bank. What is the cost? How do you what account it in the book of the account? So this cost, this borrowing cost, borrowing cost has interest. So how do you account for it? And then the borrowing cost, you cannot borrow cost. You cannot borrow, you cannot have loan. You cannot get loan from bank without you know what to do with that money. So the borrowing cost IS 23 will guide you how to use that cost, that loan you get from bank. So how can I protect that loan in order to to get what I want? For example, now the borrowing cost now. For example, you borrow a loan in order to build this building. You want to build a building, you borrow loan. As you borrow loan, there is a cost attached to that loan. So there is interest. And then I want to use it to build this land. So I have to what? I have to use it. I have to use that loan very well I have to monitor that loan very well in order to build this building. So that's a borrowing cost. A borrowing cost is simply the cost of borrowing.
Okay. Example like interest or what?
Yes,
Example.
Yes, it's like interest.
Interest on loan.
Yes, interest on loan.
Okay.
Yes, that's the borrowing cost.
Okay. Another question is this.
Okay.
What is the difference between impairment and depreciation?
Mhm. Okay. Impairment by IS 36. Impairments come about when there is a difference between the carrying amount of that asset. The carrying amount of that asset with the recoverable amount, the amount that you will recover from what in the market. Like for example, this recoverable amount is just like the fair value. I have this asset. So when I have this asset, the amount I have, the amount in my book, I have maybe 50,000. Then if I want to sell this, or if I want to sell this, I will sell it maybe at maybe 40,000. So what? There is an impairment. So that impairment, the impairment, you are comparing it with the fair value less cost to sell, or with the value in use, value for continuing use. So the value in use will be what? The inflow and outflow, and you use you will discount it to the present value and compare it with the fair value less cost to sell. Lower the lower of that. That's the which one is lower. Then you compare it with what? With your carrying amount. So the recoverable amount now, the recoverable amount will be lower of fair value less cost to sell, or value in use. That's the value you will get in using that asset, continue using that asset. But when you come to depreciation, depreciation it simply means that, like I said, is the cost. You have the cost already. You have the cost. You did not expense anything, but you have to be expensing that cost. You have to be releasing that cost into the profit and loss, because by the time you release the cost of a building, a whole building on that year, it will not, um, it will be, your account will be disturbed, because the cost is huge. And then you cannot expense, like the matching concept in accounting. You cannot expense something that you will be benefiting for 4 years in just one accounting year. So that's depreciation. So depreciation is simply means that you are charging the cost of that asset in your P&L. But impairment is when the current amount of that asset is what? Is less, is lower than the recoverable amount. But that recoverable amount is what? The standard said it is either the lower of fair value less cost to sell, or value in use. So that value in use, value continue in use, the value you continue to use, then you have to what? you have to discount it. That's, you need to take account of inflows and outflows, and then you now discount it and now take the lower of that. So that's the impairment.
Thank you, sir.
Okay. So is there any question? Or I'm coming, let me share my screen so that you. Roma did not give us the. Let me check the. Let me use this ACCA material. Let you. And that's IS 36 impairment. You see, this is the impairment. Identify possible impairment external. This. So even this one I did not explain the impairment. So, you see, this is what I'm trying to explain. You see, a recoverable amount, the greater of what? Fair value less cost to sell and value in use. So fair value less cost to sell, the amount receivables from the sale of the asset less the cost of disposal. Then value in use, the present value of what? The future cash flows from the asset. So then you take one of these and compare it with what? Carrying amount. So an impairment is when there are internal impairment and there are external indicators. So when we come to IS 36, we will understand that better. So as you can see, this IS 16. So you see, there is what? Reconstruction and measurement. Initial reconstruction, that is probable, economic, this thing. Then measurement, initial cost. Then the subsequent cost is in case the measure and has additional economic benefit. So you see the subsequent cost model or evaluation model. You see this thing. So that's all about this IS 16. So I don't know if there is any question.
No question for now from my own end.
Okay. So actually this is 11. So maybe I will drop the practical question based on cost. Based on the cost to be included the component, the cost of the components cost of an asset. So I will drop that. Then on Saturday we will treat to like depend on the time. If time permits, we find a very comprehensive custom based on that IS 16. Then that's the plan. Then after that, then we go to IS 40. So IS based on standards, and once you understand those standards, you will be okay in the exams, because sometimes these standards you have to read in between lines. You have to understand the standard. What is the standard is saying? So sometimes if you don't know the standards, then because sometimes everything is there in the custom about the standard. So by the time you know what this standard is saying, so you will not have any problem with any custom in the exams. So that's it. And then since now Ican is adopting ACCA, so we need to know how ACCA sets their exams questions, because the ACCA, they have a lot of questions based on SBR, which they have international and UK based exams. So that's, but we will check. I will drop the question as an assignment. That's based on that course component. So when we come on Saturday, then we will dig deep on that practical section. Then it will just be pure calculation.
It's all right.
Okay. So I think for now there is nothing. I don't know if Jesterh Professional Services, if they have any. Or Emeka, do you have anything to say? Or you are not with us?
Are you sure it's not just me and you that is here? Because I
So
didn't hear anybody saying anything.
So that's what that's what I'm
Because I
thinking.
myself have been struggling with sleep, but I'm still
Okay, this
forcing myself to listen.
yes, actually, that's it. But that Saturday, I think Saturday is 2 p.m. So that one we can.
I think it's 3 to 5 or so.
Yeah.
No, we'll still checking. I think it's around 3 to 5.
Okay, 3 to 5, right? Okay.
We'll check, but it's something like that. We'll
But
check.
it's two. It's two.
Oh, okay,
Yes.
2 to 5.
Yes, 2 to 5.
3 hours.
Is
Okay,
it two
no
to?
problem.
No,
It's
it's
okay.
like 2 to 4. 2 to 4. It's 2 to 4.
Okay.
Yes.
All right.
It's 2 to. Okay, I think we can call it a day. Then I
All
will
right. You've
drop.
done well, sir.
All right. Thank you. So,
Good night.
all right. Thank you. Good night. Mhm.
Yeah.
Yeah.